Welcome to The Explainer. Today, we're unpacking a major policy shift coming down the pipeline that is literally going to affect millions of savers. We are diving deep into political economist Richard J. Murphy's pointed critique of the upcoming changes to UK's savings rules, changes that are going to fundamentally alter how individual savings accounts, or ISAs, actually work. So let's map out exactly what the government is proposing, the economic mechanics running under the hood, and ultimately what this all means for your wallet. It's a question that feels like it should have a complete no-brainer of an answer, right? Where is the safest place for your savings? For decades, the answer for most cautious savers was obvious: cash. Just put it in the bank. But as you'll see throughout this explainer, a massive government policy shift is turning this fundamental question into a highly debated, incredibly timely topic. The old ground rules of safe saving are essentially being rewritten in real time.
Section 1. The 2027 ISA Shakeup.
Okay, so here's the baseline. Under current rules, you have a £20,000 annual allowance that can go entirely into a cash ISA if you want it to. But starting in April 2027, for anyone under 65, that cash allowance drops down to £12,000. If you want to use the remaining £8,000 of your tax-free allowance, you will be forced to put it into the stock market. Now, obviously, most people aren't saving 20 grand a year, so the cap itself might feel like a bit of a distraction. But it's the messaging behind the policy that really matters here. Cash savings are being actively discouraged in favor of stock market exposure. So, why the sudden pivot? Well, the government's stated rationale is actually pretty clear. They want to encourage retail investment in stocks and shares to stimulate broader economic growth right here in the UK. The underlying premise is that funneling everyday savings into city markets will fuel businesses. Though it is definitely worth noting that the government clearly recognizes a level of risk here, which is exactly why anyone over the age of 65 is completely exempt from these new rules. They don't have to change their savings habits whatsoever. Section 2. Warnings of market instability. Now, Murphy grounds his critique not in some abstract economic theory, but in harsh institutional reality. Take a look at this direct quote from Sarah Breeden, the Deputy Governor of the Bank of England, who literally oversees financial stability. She states very clearly that there is a, quote, significant risk of a stock market adjustment at present. And just to decode the polite regulatory speak for a second, an adjustment or a correction is just a nicer way of saying a market crash. And the Bank of England isn't just throwing out vague warnings. They've identified highly specific threat vectors. We're talking about overvalued shares, the very real potential of an AI bubble bursting, intense geopolitical uncertainty like the conflict in the Middle East, and hidden risks lurking within the shadow banking system. According to Murphy, pushing small, everyday savers away from the safety of cash and into the stock market at the exact moment the Bank of England is waving these massive red flags is recklessly irresponsible policy making. Section 3. How stock markets actually work. To really get Murphy's point, we have to understand this crucial distinction. The stock market is essentially split into two totally different activities. First, you have the primary market. This is where companies actually raise new money to build factories, hire people, and genuinely invest in their operations. Then you have the secondary market. This is where existing shares are traded between savers, pension funds, and hedge funds. When you buy a share in the secondary market, you are literally just buying a second-hand share. The actual company whose name is on that stock ticker, they receive absolutely nothing from that transaction. Not a single penny goes to their business growth. And the sheer scale of the numbers here is just staggering. It completely reframes the narrative. Take a look at this breakdown of the London Stock Exchange. The total value of the exchange is around £3.5 trillion, but the value of shares traded annually is actually higher, around £5 trillion. That means more shares are traded every single year than actually exist. Yet, the amount of new money raised for companies, that primary market investment we just talked about, is only between 10 and 30 billion pounds a year. To put that into perspective, a staggering 99% of all stock market activity is just the trading of secondhand shares. Only about 1% represents new money going to companies for real economic investment. For Murphy, this completely shatters the government's core premise, the idea that forcing your savings into the stock market will directly fund UK business growth is fundamentally flawed. The link between you buying a share on a trading app and the creation of real-world value is virtually non-existent. In fact, here's a reality check that might surprise you. The level of tax subsidies offered to the City of London for pension and ISA savings are actually larger than the total amount of new money delivered to UK businesses for things like machinery and job creation. When you buy secondhand shares, your money just goes to the seller, while city operators take their cut. They have every incentive to push for high-volume trading, regardless of whether it genuinely aids the broader economy. Section 4. Navigating Risk and Uncertainty.
11 million. That is the number of adults in the UK who currently hold ISAs, and the vast majority of those funds are sitting safely in cash. According to Murphy, these 11 million everyday savers need to prioritize their own financial safety right now. His central piece of advice is incredibly simple. Do not let government policy panic you into taking on risks you aren't comfortable with, especially when global markets are this deeply uncertain.
Which leads us to a highly pragmatic, if slightly contrarian, viewpoint. ISAs are really just a tax wrapper. You don't have to save in a tax-free way. If you're a cautious saver steering down a potentially volatile market, it might actually be far better to keep your money in safety and just pay a little bit of tax on the interest, rather than blindly dumping it all into the stock market just to chase a tax break and risking the loss of your principal amount entirely. So how do you actually make this call? Murphy outlines a pretty philosophical approach to making financial decisions during a crisis. Step 1 is to deeply assess your own personal risk tolerance. What actually helps you sleep at night? Step 2 is to make your financial move, whether that is heading for the safety of cash or deciding to ride out the market risks. But step 3 is absolutely crucial. Document your reasoning. Treat it like a personal time capsule. Write down exactly why you made the choice you did right now in this specific economic climate. Now, you might be wondering, why go through the hassle of writing it down? Because it's the ultimate safeguard against hindsight regret. Look, the market is entirely unpredictable. It is totally possible that the Bank of England is wrong, no crash happens, and the stock market absolutely soars. If you move to cash, you might miss out on those gains. But if you have it written down that you chose safety because global risks were out of control and you wanted peace of mind, you'll understand your motives. You won't regret the decision because you'll know for a fact you acted rationally with the information you had at the time. Which brings us to our final thought. The government is heavily incentivizing one path, while economic realities and institutional watchdogs are pointing to significant dangers on that exact same path. As these 2027 rules approach, you've got a choice to make about your own financial security. So ask yourself, in a highly volatile, deeply uncertain market, will you follow the policy or will you follow your instincts? Think about what we've unpacked today, assess your own risk, and let that guide your next move. Thanks for joining us for this explainer.